I don't know about you, but when I look at the super fund's investment menu, I usually get overwhelmed by the sea of different investment options. What is single sector? What is multi-sector? Growth? Defensive assets? What is life cycle? Mysuper option? I might know what I wanted before I check the menu now that I'm totally lost in front of so many choices. In this video, let's break down different types of super investment options and look at the winners out of 404 multi-sector super options based on the Morningstar survey by September 2023. Now let's get started. Every month, our super fund receives the superannuation guarantee and any voluntary contributions from ourselves. The investment option determines how this money is invested. If it is investing in a single asset class, typically shares, bonds, or they call it fixed income, cash, property, and these individual options are called single sectors or specialist asset class options. Let's take Australian Super's single sector options as an example. They offer 2 share options, Australian shares and international shares, 1 bond option, diversified fixed interest, 1 cash option. We're not restricted to only investing in one asset class, as typically you are invited to do it yourself and allocate the percentage of each asset class. And this means that I can, if I think it's the right strategy for my current situation, to invest 100% of my cash into Australian shares, or I can allocate 40% on Australian shares, 30% on international shares, 20% on bonds, and 10% on cash. And 100 people would literally have 100 different asset allocations. And this hands-on approach requires a bit of investing experience. In return, it gives you some control over how you like your money to be invested. Essentially, you are building your customized portfolio by mixing several single sector investment options. If you prefer a hassle-free and hands-off option, there are pre-mixed options that already bundle several asset classes together, and this is called a diversified option. Diversified option can also be called multi-sector or multi-asset options. The advantage of using diversified investment options is that the super fund decides the mix of assets to buy for you, which saves your time to decide. The downside of multi-sector options is the asset allocation between different asset classes is fixed and typically based on a spectrum from conservative to aggressive, which is a bit rigid to some extent. And compared with buffet-style single sector options, people on multi-sector options typically only pick one option. Let's look at Australian Super's pre-mix options. The spectrum from lower risk, lower return options, stable option, to conservative, to balanced option, to higher risk, higher return option, high growth. What they do is allocate the investments between growth and defensive assets. Now, what are growth and defensive assets? Shares and property are considered as growth assets because they are meant to grow in value over time. Bonds, cash are considered as defensive assets as they are less likely to fall in value before inflation is adjusted, and their value doesn't fluctuate that much as growth assets. However, it's not always as straightforward as what the textbooks tell us. In fact, some growth assets can also be defensive and deliver income. For example, shares can deliver dividend income and property can deliver rental income, while defensive assets like infrastructure can also rise in value. The typical rule of thumb is that the more growth assets in your investment option, the better your chances of making more money over the long term. But your returns may jump around more from year to year in the short term. In other words, the returns are more volatile, and so they have what is known as higher investment risk. On the other hand, the more defensive assets in your investment portfolio, the lower the expected longer term returns. But that should come with lower volatility and less investment risk. This is the risk-return trade-off most finance textbooks talk about. Besides the DIY single sector and the pre-mixed multi-sector options, some super funds started to offer life cycle options that are becoming more popular in Australia following its wide use in the US. And these options are very similar to the diversified multi-sector investment options. And the difference is they use your age or how many years until retirement as the reference to decide allocation between growth and defensive assets. In Vanguard Super, for example, if I put the age to 40, it will suggest my growth assets should take 90% of the total portfolio because I will have another 2 decades until retirement. If you're 60, the allocation between growth to defensive is suggested to be 60 versus 40. As the allocation changes through different stages, another important thing to watch out for in these types of life cycle options is how does the fund rebalances the account for different investment strategies as we get older. Do they physically swap you from one option to another, meaning you will be forced to sell units in one option and buy units in another, triggering capital gain tax, or adjust the investment strategy across the investment options whole portfolio based on the average age of all the people in that option? What if I can't decide? Having many investment options is great if you are comfortable making investment decisions, but if you're one of the many millions of super fund members in Australia who can't decide which option to choose, then your super fund will assign you to its default investment option. This option is called Mysuper option, which is usually a balance option from the multi-sector. For example, Australian Super's Mysuper option is the balance option from the pre-mix, and Vanguard Super's Mysuper option is its Lifecycle option. Morningstar does quarterly review of all the multi-sector super options. The 33-page that I'm holding is the latest survey result out of 404 options, but when I started to glance through it, I found the ranking given by Morningstar was only based on the total 3-year and 5-year returns. This is a big bug, to my opinion. First of all, superannuation is a long-term game. I would like to start at least a 5-year plus investment horizon. And second of all, why didn't they use the after-fee net returns as the measurement to do the ranking? So I did a bit extra work, that is to work out the annual returns after fees. And after fees were considered, there were funds that was ranked number 4th, number 11th came to the top. If you would like to download the PDF, I'll leave the link below. Now, let's get to the conservative option first, which primarily includes defensive assets like bonds and cash. The typical asset allocation between defensive to growth assets is roughly 65 versus 35. The benchmark of Morningstar 5-year total return is 1.1% per year with an average cost ratio of 0.78%, leaving it a 0.32% annual return after fees. The winner is Brighter Super Secure Super Option with net return after fees 1.26%. The benchmark of Morningstar 10-year net return after fees is 1.62%. The winner is OnePath 08 FRPS with 1.84% per year. Fees are the one factor that eat away most of our returns, and we also need to consider the inflation, as the net return after inflation is our real purchasing power. So to make it more clear, I'll leave the average annual inflation rate of the past 10 years here, which is 2.3%, to see if each winner super option is working hard enough to increase its value after inflation. In this sense, your money will lose value every year if your super account is in either of these two options. Now, let's look at moderate option, which typically allocates half defensive, half growth assets. The benchmark of Morningstar 5-year total return is 2.2% per year with an average cost ratio of 0.69%, leaving it a 1.51% annual return after fees. The winner is Vision Conservative Super Option with net return after fees 3.38%. The benchmark of Morningstar 10-year net return after fees is 2.71%. The winner is also Vision Conservative Super with 4.38% per year. If we further deduct the inflation rate of 2.3%, the net return after fees and inflation are 1.08% and 2.08%. Now, let's look at balance option, which typically allocates 40% defensive and 60% growth assets. And most of the super funds set their default investment option, Mysuper option, to this balance option. The benchmark of Morningstar 5-year total return is 3.7% per year with an average cost ratio of 0.61%, leaving it a 3.09% annual return after fees. The winner is the Host Plus Conservative Balance Super with net return after fees 5%. This is one conservative option down from Host Plus default option, balance option. The benchmark of Morningstar 10-year net return after fees is 4.59%. The winner is also Host Plus Conservative Balance Super with 6.1% after fees per year. We further deduct the inflation rate of 2.3%. The net returns after fees and inflations are 2.7% and 3.8%. Now, let's move on to the growth option, which typically allocates 15% on defensive, 85% on growth assets. The benchmark of Morningstar 5-year total return is 4.8% per year with an average cost ratio of 0.73%. leaving it a 4.07% annual return after fees. The winner is the Host Plus Socially Responsible Investment Balance option with net return after fees 6.07%. The benchmark of Morningstar 10-year net return after fees is 5.47%. The winner is Australian Super Balance Super Option with 7.4% after fees per year. If we further deduct the inflation rate of 2.3%, the net returns after fees and inflation are 2.7% and 5.1%. Lastly, let's look at the aggressive option, which usually allocates 10% on defensive and 90% on growth assets, or sometimes all in growth assets. The benchmark of Morningstar 5-year total return is 6.3% per year with an average cost ratio of 0.79%, leaving it a 5.51% annual return after fees. The winner is the Art Shares Sub option with net returns after fees 7.08%. The benchmark of Morningstar 10-year net return after fees is 7.11%. The winner is Mysuper High Growth Super Option with 8.92% after fees per year. If we further deduct the inflation rate of 2.3%, the net returns after fees and inflations are 4.78% and 6.62%. Imagine 10 years ago, if we had an initial $10,000 in super account with 600 monthly top-up, a salary guarantee into each of 10-year winner super options, we would end up with the money here in absolute money amounts, meaning without considering our actual purchasing power after inflation. If we consider the real value of money, here are the real value amounts. You may wonder which super option is my super account. Well, my super account is in the DIY single sector that you can check this video here to find out why I chose that option. My name's Irene. I'll see you next week.